Okay, I'm ready to begin. Exercise 14-210 issues bonds with a par value of $180,000 on January 1st, 2013. The bond's annual contract rate is 8%, and interest is paid semi-annually on June 30th and December 31st. The bonds mature in 3 years. The annual market rate at the date of issuance is 10%, and the bonds are sold for $170,862. Number one, what is the amount of the discount on these bonds at issuance? So, what did you figure out?
It is 9,138.
And tell me how you got that.
180,000 minus 170,862.
So discount, what we did was the 180,000 was par value,
Yes.
and the 170,862 was the
Was
issue.
yeah, that market rate issue. Yeah.
Okay.
It was sold for.
All right. Number two, you're finding out the total bond interest.
Yes, and what I did was I took 6 payments for 7,200, which equaled out to be 143,000.
Okay.
And then the par value at maturity.
Wait a minute. You did 7,200 times 6 payments, and it came out to what?
43,000.
Calculate that again.
Sorry, let me see. $43,200.
200. Okay. And then what next?
Okay, the par value at maturity, which was 180,000,
Okay.
and then the total repaid, which was just adding the 43,200 to the 180, which was 223,200.
223,000.
200.
200. Okay.
Less the amount borrowed, which is the 170,862.
Okay.
And then the total bond interest expense is just minusing the 223 from the 170, which equals 52,338.
Okay. All right, give yourself a hand. That was good. Oh wait, you got one more?
Number 3, the straight line, yeah. That's gonna be like, yeah, you got a whole nother page.
No, you know what? I can.
Are you sure? You got 1, 2, 3, 4,
Oh
5,
wait,
6,
this is
7.
what I can do. All right.
So we have the straight line. We're gonna do like 3 lines. It's gonna be period, and then unamortized discount, and then carrying value.
Unamortized discount.
I like how you say it. I always mess up.
And then carrying value.
Yes.
Okay, 3 columns.
All right. So on January 1st, 2013, the unamortized discount is 9,138, and that's from the very first part of it.
Right. Okay.
All right. You wrote 9 up there. That should have been way up there at the discount. I just noticed that.
Up where? I'm sorry. Oh, 8. Okay.
Yeah. So then the carrying value is 170,862.
Okay.
And that's from the very beginning.
Right.
All right. So now, what I did is I took the 9,138 and divided it by 6 payments, and that turned out to be 1,523. So,
Okay.
okay, so in 6/30/2013,
Uh-huh.
I'm gonna minus 1,523 from 9,138 and come up with 7,615.
So what you did was the discount was 7,615, and you're basically subtracting this 1,523 from the
From that.
9,138.
Yes.
Okay.
Now, on the other side, what I'm gonna do is add it.
Mm-hmm.
So it's gonna be 170,862 plus 1,523, which equals 172,385.
Okay.
And basically, it's just gonna go on the same way all the way down.
Right. So give me the other dates.
12/31/13,
Uh-huh.
and it's gonna be 6,092.
Okay.
And on the other side, 1,073,908.
Okay. Next.
And then 6/30/14,
Mm-hmm.
and then 4,562,
Mm-hmm.
and 175,431.
Okay.
And then 12/31/14, 3,046, and then 176,954. And then 6/30/15, 1,523, 178,477.
Okay.
And then on 12/31/15,
We reached what?
0 and 180,000.
Which was also considered what?
Par value?
Par value. And this was by 12/31/15,
Yes.
which was the maturity date.
Yes.
Good. Now you can give yourself a hand clap.
Good job on that one. All right, Ms. Andreessen, exercise 14-3. Sanford issues bonds dated January 1st, 2013 with a par value of 500,000. The bond's annual contract rate is 9% and interest is paid semi-annually on June 30th and December 31st. The bonds mature in 3 years. The annual market rate at the date of issuance is 12%, and the bonds are sold for $463,140. Same thing. What is the amount of the discount on these bonds?
36,860.
Okay, let me get to another screen. So this is exercise 14-3. And how did you get that discount?
I took the par value of 500,000 minus what it sold for at 463,140.
Okay. Number 2, to find the total bond interest.
I came up with 230,551. But when I did the table on the third part,
Uh-huh.
I ended up stopping at the fourth payment because it came to 0 and I got to 500,000.
Okay, let's
So
work through.
what I did wrong.
Let's work through it. Trying to find out the total bond interest. How many payments did you have?
When I did the table, I made 4.
I'm saying in the problem, how many should it have been?
6.
6 payments. Now, the way that you're going to find out 6 payments of what, you had your par value of 500,000, correct?
Yes.
So if you take your par value, what was your interest rate?
45,000.
Your interest rate.
I'm sorry, I can't. No, 9%.
Okay. So times 9%, and it's semi-annual payment, so you multiply that by half. Tell me what that amount is, Miss Andreessen.
90,000?
Huh?
Oh, wait, no, 45,000.
500,000 times 9% times half.
22,500.
So the 22,500 are the amount of the 6 payments, okay? So 6 payments times that amount gives us what?
135,000.
So we got 135,000, and then you said your par was 500,000.
Yes.
So when we add those two together, we get how much?
635,000.
So that 635,000, that becomes the total that was repaid. And now we need to
Okay.
subtract out what?
Amount borrowed.
Let's see. The 36,860.
Didn't you borrow an amount?
Borrowed and
You need to subtract out the amount borrowed. How much did you borrow?
oh, the 463,140.
That's it. 463,140, and that gives us how much?
171,860.
Okay, so that is our bond interest, 171,860. Now you can do the amortization table. We got 6 years we're dealing with, right? Give me, what columns did you use?
The first one with the period.
Okay.
The second one is cash interest paid. The third one is bond interest expense. Then discount amortization. Then unamortized discount. And then the final one is carrying value.
I have a question. Why do they have more columns than we do?
We'll get to that.
Oh, okay.
We'll get to it.
Cause I'm like confused. Hold on.
Okay, now tell me all the periods, all the dates, Miss Andreessen.
1/1/13,
Uh-huh.
6/30/13,
Uh-huh.
12/31/13, 6/30/14, 12/31/14, 6/30/15, and 12/31/15.
All right. Now, cash paid interest or cash interest paid, we don't have to calculate that because what was the interest paid? We figured it out already. How much was each payment?
22,500.
So of course, if they had 6 payments, we're talking about 1, 2, 3, 4, 5, 6, not the first year that we took it out, right?
Correct.
So 22,500 for each of these years. And then the bond interest, that's what changes. And how do you think it changes?
You take the prior period's carrying value and you multiply it by the market rate.
Now, what was
which
your
is,
market rate?
the market rate was 12%.
But it's semi-annual payments, so we do what with it?
Oh, 6%.
Right. Divide that by
Um,
2 equals 6%. So if we're finding the bond interest, the unamortized discount for the first year was how much? 36,000. I see up here 36,000.
860.
860. And the carrying value was at 463,140 for the first year.
Yes.
The bond interest expense, you said the 6% or the market rate times whatever the prior was, right?
Yes.
So tell me what the first amount is for June 30th, 13.
27,788.
And tell us how we got that.
You take the 463,140 times the 6%, and that's what it equals.
Okay, so that means we're gonna do that for each one, right? We're gonna take whatever the
Yes.
new carrying value is, multiply it by that 6%.
Mhm.
Okay, so everybody can tell me the rest of them.
So what about the discount amount? That's nothing?
We haven't gotten there yet.
So the 27,788 doesn't apply to the first year, it's to the 630, not to the 1-1.
Nothing's happening as far as cash interest, bond interest, or discount on the first year of the bond.
And are we subtracting the 27,888 from the 463,140?
Boy, where are you? I just want y'all to give me these numbers. No, I'm sorry.
Because I can't
I'm
get
sorry.
that number. I don't know
All right.
what's going on.
So discount, you're right. Discount. The discount amount is gonna be cash, right? I'm sorry, bond interest minus what?
The 22,500.
The cash interest paid. So take your bond interest amount of 27,788, subtract out 22,500. That's the discount amount.
5,288.
Okay. Now unamortized discount. Obviously, you're gonna take this 5,288 and subtract it from where?
The unamortized discount, the
That's it.
36,860.
Which equals
And
what?
you get 31,572.
And then you take this same 5,288 and multiply it. I'm sorry.
You add it back.
Add it to where?
The cash, the carrying value.
To get to 500,000, right?
Not 500,000. What's the amount? 31,572 plus 463,140.
Okay.
Equals 4.
No. I'm sorry. 5,288 plus 463,140 gives us what?
468,428.
So
see, I did it by taking the par value, the 500,000, minusing column D, the 31,572.
that's fine too.
Yeah. Yeah.
Oh, okay.
That's fine too.
That's what I saw when I did that too. That's how I was like, she said, no, okay.
Okay, so
But they still come out to the same number?
yes.
Okay.
Now for 12/31/13, bond interest amount is what? You're taking this new carrying value of 468,428 and multiplying that times 6%.
That's 28,100 and 28,106.
And then 28,106 minus 22,500 gives us
56,600.
5,000.
$5,606.
Okay. $5,606 subtracted from the unamortized discount of 31,572 gives us what?
25,966.
And then the new carrying value.
Add it back to that, right?
Mm-hmm.
468.
That's 488,394.
What'd you add?
Added the 25,000 to.
No, you
Not
add
that, okay. Well, then you can't get it together right
It's 442,462.
Whoa.
Whoa. Yeah.
468,428 plus $5,606.
That's 468, 094.
What? 468,428 added back to 5606, right?
Yeah.
Okay, 474,034.
468. I thought it was the 2.
Bless your heart.
Yeah, because we are. I'm struggling.
I heard all types of
I'm
things.
going to
Okay.
struggle with this.
I already took the test. They over with.
So next, the new bond interest amount.
So that's the 28,106 times the 6%, right?
So 47
$474,034, which is the new carrying value times 6% market rate.
I can't see the numbers, Ms. Williams. 474,034 times 0.06.
that,
28,442.
Okay, 28,442. And 28,442 subtracting out the cash interest paid of 22,500.
5,942.
5,942. 25,966, which is the unamortized discount. Subtract out the discount of 5,942.
20,024.
And the new carrying value, $474,034, adding plus 5,942.
It's 479,976.
Good gracious.
All right. 12/31/14, 479,976 carrying value times the 6% market rate.
28,799.
28,799 minus 22,500.
26,549.
28,799.
6,299.
6,299. 20,024 subtracting out $6,299.
13,723.
13,723. Carrying value 479,976 plus 6,299.
486,275.
All right, 486,275 times 6% market rate.
29,177.
Did you round?
Yes.
Yes,
Don't round.
That's 76.5.
0.5. So we just chop it off the ending?
Yeah.
Okay.
All right. 29,176 minus 22,500.
6676.
6,700. Oh, 676. And then 13,723 minus 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676. 6,676
7,047.
47?
Yes,
Yes.
You sure?
yes.
Oh, this is wrong. This is wrong. Go back to the previous one.
Okay.
$20,024 minus $6,299.
13,725.
Okay, I have 23 up here, so it's 25.
Right.
Now going back to where we were, 13,720.
7,049.
486,275 plus 6,676.
492,951.
And 492,951 times 6% market rate.
29,000.
29,577.
This is a time now where we have to adjust it for the purpose of rounding to get back to par value. You said 29,005 what?
77. 29577.
Uh,
Then the next one would be 7,077.
yeah, the next one really needs to be this for the discount. So if we did 7,049 here, and if we took 7,049 and subtracted from here, obviously it's gonna equal 0, right? 7,049 added to 492,951, what do you get?
500,000.
500,000. So that means that we need to adjust the bond interest for the sake of getting back to par, adjust it to 29,000, or better yet, do this. Add 7,049 plus 22,500 and tell me what you get.
That's 27,788.
It shouldn't be.
29,549.
That's it. 29,549. And I'm gonna put a star here because what we did was we adjusted this just so we could get to a 500,000 solution. If we didn't care about getting back to this par value, you could have put the 29,577, whatever it was.
And in the test, it automatically does that for you.
Good.
You know, you don't have to figure it out. It'll come to the bottom line for you.
Good. Okay, good. Give them a hand. Give all themselves a hand for working through that.
I know, but I'm gonna have to look at this again before I get home, because I'm just gonna be like, what the?
Okay, so we gotta go through these last two relatively quickly. Exercise 14-6.
Right, so that'll be me.
Yeah. Paulson Company issues 6% 4-year bonds on December 31st, 2013 with a par value of $200,000 and semi-annual interest payments. Use the following bond amortization table and prepare journal entries to record A, the issuance of the bond, B, the first interest payment, and C, the second interest payment. So,
Now, I might be wrong. What I did is I put A, which is the first one, on 12/31/13. And then I put cash.
Debit cash.
Yes, for 186,534, which is the carrying value.
Carrying value, okay.
Okay, and then I put premium on bond payable.
It's not a premium. What is it?
It's just the regular bonds payable.
Part of it.
It's not a regular bonds payable.
The issue part of
The bond was worth how much? What's the par value of the bond?
it, 200,000.
And how much cash was received? You just told me.
$186,000.
Isn't that less than 200,000?
Yes.
So that means a discount, not a premium.
Okay, so that was 13,466.
What's the account? Discount.
Discount.
Yeah, okay.
Discount on bond payable.
Okay, thank you. Discount, okay, discount.
And then
And then
credit
bond-
what?
And then I put bonds payable 173,068.
Huh?
Because.
No,
I
it's
put-
just the 200,000. That's the
Yeah,
par
you gotta go
value.
back.
Oh, okay, the discount.
This is
Okay,
just to record the issuance of it.
Okay, gotcha. See, I did it backwards, okay, because I thought it was a.
So now 2014 B, where we're recording the first interest payment for June 30th. What do we debit?
I debited 3,508.
No, I mean the account.
Bond interest expense
Bond interest expense
for 3,508.
was, considering you were thinking it was a premium, that's not right.
That's not right. Oh.
You got a bond value of 200,000, right? What was the interest rate?
The interest rate was 6, so it should have been 200,000 times 0.06
Times,
times 1/2.
Uh-huh.
Okay, gotcha. So,
which equals what?
anyone do the math? Let me go ahead and do it then.
Okay.
Okay, so that's 200,000 times 0.06. So that's 6,000.
200,000 times 6% times half.
0.06 divided by 2 is 6,000.
So
6,000.
6,000 is what number?
It's gonna be the cash.
Yes,
It is the
Mhm.
cash.
it's the cash.
6,000 is the cash.
So we're gonna credit cash for at least that $6,000.
Yeah. And then the premium on the bonds payable.
Not premium,
I'm sorry, discount.
discount
Is 1,684.
on bond payable is 1,684.
Yes.
So what is your total bond interest expense?
Okay, so that's minus 6,284. And it's 4,000.
No,
No.
you only debited bond interest expense. 1,684 plus 6,000.
Oh, plus. Okay, so it's backwards. 6,284. It's gonna be 7,684.
Now, we found out the 6,000 cash, right?
Yes.
You need to tell people how you got the discount of
This-
1684.
All right, so that's 13,466
Uh-huh.
minus the 11,782.
What was the 11,782?
That is,
The unamortized discount.
Unamortized discount?
yes, on 6/30/2014, and it's gonna be minus the amortized discount of
Okay.
12/31.
So now see the second interest payment, 1231.
It's
Same thing.
same
Yeah.
thing. Yeah, that's what I was gonna say. The same exact thing.
So bond interest expense,
So this is
7,684. Discount, bonds payable, 1684. And then cash, 6,000. Okay, good. Give yourself a hand. And then last one, exercise 14-8. (14-8) says Woodwick Company issues 10% 5-year bonds on December 31st, 2012 with a par value of 200,000 in semi-annual interest payments. Use the following bond amortization table. Prepare journal entries to record the issuance, the first interest payment, and the second interest payment. So technically the same thing, might be different accounts being used. So Ms. Andreessen, first journal entry to record the issuance of it.
12/31, debit to cash, for $216,222.
Okay,
A credit to premium on bonds payable, $16,222. And then, credit to bonds payable, $200,000.
now, tell us where you got this, premium from.
The par value is 200,000, so I just, subtracted the carrying value, the 216,222 minus the 200,000.
No, the premium itself, how did you get the premium? 200,000, which is par value, times what? Did it just give it to you?
Yeah, just give it to them.
They didn't give you any
Carrying
interest?
value.
It didn't give you any interest rate or anything?
No, just
Okay.
carrying
10%.
value.
10%?
10%.
So if you did 10% and then also multiplied it by 1/2, you would have still came to
Gotcha.
the premium. All right. So the next one for B, what's the date?
630.
6/30. Tell me the journal entry.
Debit to bond interest expense,
Uh-huh.
21,622.
Mm. Mm.
I started doing the same table as the previous exercise,
Uh-huh.
and that's how I came
Okay.
up to my numbers, but since I did the first one wrong, I probably did this one wrong.
Well, let's go through it. You had a calculate the 200, and I actually technically already did it up here for you. But 200,000 times 10% times 1/2 gives us what?
The 16,000.
10,000.
10,000, right? 10,000 is your what? Just like it was on the last problem.
My cash
Yep.
interest fee,
That's it. Cash. So debit to bonds interest, debit to what else?
premium on bonds payable,
Okay. And then a credit to
to
cash. We already know the cash amount is 10,000, right?
Yeah.
Bond interest expense.
But isn't it semi-annual?
It is semi-annual.
So,
Okay, got it.
216,222 times.
Your 16,222, you need to subtract out what?
Minus 14.
What was the unamortized? 14,600.
It's 1,622.
Okay, so 1,622 becomes the premium,
Yeah.
Bond.
and simply subtract that from 10,000. That will be your bond interest.
8,378.
8,378. And I'm just gonna put a star here. And then of course the journal entry for 12/31 is gonna be what?
The same.
No, it changes.
No, it's the same. It's the same because it's just the second half payment.
Oh, okay.
When you guys do these types of journal entries, the step or steps that you need to take first is to find out whether it's a premium or a discount. First step. Once you find out whether or not it's a premium or a discount, because all of the problems won't be like that one where they're giving you the carrying value. Okay, so find out whether it's a bond or a discount. if it is a discount in your journal entry, you won't debit discount your credit discount on bond payable. So once you find out whether or not it's a premium or a discount, you need to take the premium or discount and subtract out whatever the unamortized is to find out what that actual discount or premium is going to be. That's step 2. First step, find out whether it's a premium or a discount. Second step, subtract unamortized from the premium given to find out what part of that premium is going to go towards the interest payment. Step 3 at that point is to find out how much cash is to be paid out for the interest payment. Got it? Okay, give yourselves a hand for that one. And I'm going to stop this recording.